Hello and welcome everyone. This is John Person from PA Stock Alerts. Today, unemployment headline number fell from 9.7 to 9.4%. While that seems great, and I believe in the weekend newspapers, by the time everyone in America reads the newspapers and they feel better that there are more Americans employed, it still is a tricky number because we only created less than what we were expecting and as far as new jobs created in the month of December. And with the height of the retail, you can really digest these numbers. I think the bottom line is that the numbers were not as great as expected. It is showing that we are going to see slow jobs recovery. In fact, Ben Bernanke even stated that we may see a prolonged period of economic recovery, not only in the housing, but also in the jobs market, and this may concern the equity markets. We had a spectacular rise in equities in the last quarter, or actually 2 quarters, and if I can show you in the chart here, what you're looking at is from Genesis Software. This is the Person's Pivots. This is a weekly outlook. That's what these horizontal lines are. The green arrows are the PPS, Person's Pivot studies, and this gives a momentum indicator giving us buy and sell signals. And as you can see, as I go down here, we've been in a daily buy mode since approximately December 1st. The buy signal was generated at 12:02. Now, down below the chart here, this blue graph depicts the McClellan oscillator, which gives us a reading of advancing versus declining issues. There's a little bit more to it, but bottom line, the theory is if we see a rise in prices, we should see a rise in the amount of issues advancing versus declining. And as you can see, there is a significant bearish diversion building in the market. As we look at this, we see that while prices have risen steadily, it doesn't show overall broad-based or broad width of the market rallying or participating in this rally. As you may hear certain stocks making new 52-week highs, they're not continuously making new 52-week highs. And even in fact, the beginning of the year, notice that we were trading up around 78 in the reading, and now we're down to about a -5. So on a daily basis, while we've seen higher highs in the stock market, we've seen lower advancing versus declining issues. So this is showing us a little bit of bearish divergence, as we call it. Now, I'm going to switch forces here, and I'm going to change this to a couple things. This is now a weekly chart, and as you can see, we've had a spectacular rally in the market since the August lows back here at around the 1037 level. So the stock market has seen a significant advance. While it is true, in June, we saw a rise in the McClellan oscillator as it reflects advancing issues outpacing declining issues. Notice what has happened with this. Since approximately the beginning of October, we've seen the McClellan oscillator on a weekly basis. Not only as we see higher prices, we see lower advancers versus decliners. So we have a bearish divergence on a weekly combined with a bearish divergence on a daily. This could mean something. It could be a significant tell that the market is due and ripe for correction. I know a lot of people are bullish in the market. A lot of people are also calling for a correction. And there's 2 ways that we could play this. With today's unemployment report and combined with Bernanke's testimony, this may put a little bit of fear in those who have been long this market to finally say, let's take something off the table. We already started to see retailer stocks like Ralph Lauren. We've seen Ann Taylor, Liz Claiborne. We've seen a Macy's. We've seen a tremendous amount of retailing stocks already be downgraded, as well as we see a lot of these stocks being pushed lower in the first few trading days of the year. Now, there's a couple things I want to portray to you. There's my friend Jeff Hirsch over at Stock Traders Almanac, who is my co-author of the Commodity Traders Almanac with me, states that the first 5 days of the year as goes the year. Well, that's okay. The market, as you may recall, started off around the 1253, 1255 handle in the S&Ps. We might see a rally, and if we pull back today, Friday, Monday, we get that 5 days rally, and then that theory comes to fruition. But what I'd like to point out to you is that doesn't mean the market's going to continue higher into the 3rd week of January. The middle graph here on a weekly basis is a seasonal representation of what the average typical price move of S&P has done since its inception. As you notice here, we generally rally from about the early part of October, and we rally going into approximately the first week of January. And quite frankly, we've seen that exact same scenario. Yes, there's a couple bumps along the way. Generally around November 12th, you get a little sell-off, and we did get that sell-off. Look at this. And then the market rallies, and then on or about the beginning of December, you get a couple days sell-off, and look, we got that as well. And then, boom, we rally right into the first week of January. All right, let me go and do a forward look for you. Ow, look at this. Typically, the market gives us a sell-off. And as I line this up, typically the market sells off by next week, headed into almost the third week of January into the first week or third week of February. So we might be looking at a potential correction. Corrections, folks, come in two ways. A, they can move sideways and just slosh around in a choppy trading range, or we may see a significant pullback. So the key is, where are we going to pull back, and are we looking at buying certain stocks? What stocks will we look at? You know, it's interesting to note that even today, as the equity markets kind of are starting to drift sideways, we look at the gaming sector. Looking at MGM real quickly with you. MGM is, in fact, up today. It's breaking out to new highs, as is Wynn. And in addition to that, we are also seeing, as Wynn Resorts is just taking a massive move today, as is Las Vegas Sands. So it begs the differ. I guess the real issue of the economy is if it's recovering, on one side of the coin, we don't have a great expansion in jobs being created. But on the other side of the coin, those that do have a job may be more willing to spend money. And so with looking at the gaming sector, it's a kind of a good tell that if anyone's got any extra disposable income, they're going to go to Las Vegas. And so it bodes well for the overall economy if these markets sustain these gains in this run-up. And I know a lot of the gaming sector also has to do with the revenues created from China and Macau. But I want to point out to you that if the Las Vegas reports come out that rooms are being filled, that and the tables and the slots are seeing action, that's good revenue growth. That's what Vegas is all about, as well as entertainment selling out. So the bottom line is this. I believe that as the economy, certain pockets are going to improve. There's going to be a stock picker's market to continue. The overall equity market may see a correction coming into the first week of February, let's call it, on average. The past historic tendencies of the market do not lie. And history does tend to repeat itself. After all, anyone that's been bullish in the market since August, that's been on the long side, probably wanted to see this market ride through the first week of January to try to milk everything they could out of their positions, and now they're going to probably take a profit so they can defer those capital gains into 2012. So this could be the beginning of a slight correction in the marketplace, and according to the McClellan Oscillator, both weekly and dailies confirming bearish divergence, but more importantly, the seasonal tendencies is showing that this market may head lower as it traditionally does. So the key is, what do? If you're long, this might be a good point to take profits, take some defensive action, buy some put options since the VIX is at a relatively low level. Then, in addition to that, start your shopping list, because that's what we're doing. My partner here at PA Stock Alerts, Tom Aspray, as well as myself, John Person, PA Stock Alerts is our advisory service. We are looking as a shopping list and looking to take advantage of a market correction to get capital back to work into the game. Tom and I concluded the year as we put together PA Stock Alerts from the beginning of July in stock picking only, not using leveraged vehicles, no options, just trading stocks. Finished from the 5.5 months that we started this advisory service, up 29.3%, and the performance can be reviewed at our website, PA Stock Alerts. This is what our results tally. If you want further information, simply click on pastockalerts.com. That is our website, pastockalerts.com. I wish you a great, healthy, prosperous new year, and let's see how the market fares in the next 3 weeks. Get some cash ready, because we believe there's going to be some exciting opportunities in certain stocks and certain sectors, and that's what we're focused on for the next coming few weeks. Thank you, everyone.